This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks. I'm John Budden, and welcome to Money Talk. Here's the lineup for today's show. We start with Dave Sally of the Ottawa Business Journal, then to my weekly chat with Matt Hendricks of Sprott Asset Management. After the break, BNN's Greg Bunnell talks about the possible takeover of Macys by Hudson's Bay Company. After that, John Ehrlichman of our affiliate BNN takes a look at the possibility of Snapchat going public. We go to the news, and then Catherine Murray of our affiliate BNN interviews Ron Mayers, who is a family office executive at Blue Ridge Wealth Management. Then to the final break, after which we go to John Ehrlichman again, who interviews Jameson Burkow on Toronto home prices. And to conclude today's show, Catherine Murray talks with Lindsay Wasser, partner and co-chair of Macmillan's Cybersecurity Group. But first, to Dave Sally of the Ottawa Business Journal. How are you, Dave?
Not too bad, John. How are you?
Oh, good. The sun's out, and skiing is very good. A little bit nippy, but it's a way we get through winter.
That's right.
And have you been curling lately?
Yes, I was in a bonspiel last weekend, as a matter of fact. Well, we had fun, let's put it that way.
Well, another good way to get through winter. But the business at hand, Dave, Ottawa's Calian Group has started what is sure to be a momentous 2017 on the right foot, announcing record first-quarter profits this past week. Meanwhile, local real estate developer Windmill says it is partnering with a South End church on a new project.
That's right, John. Well, let's start with the Calian Group, which is off to a record-breaking start in fiscal 2017. The Ottawa-based professional services firm this past week reported a record $68.7 million in first-quarter revenues, up 6% over the same period last year. The company's quarterly profit was also up 10% to $3.4 million. Calian operates 5 main service lines in healthcare, training, IT, engineering, and manufacturing. CEO Kevin Ford told investors this past week that each branch has the opportunity to grow independently of one another, but he added he's excited about the possibility of convergence, for example, by applying the company's training expertise in the healthcare sector. Looking ahead, one of the company's major contracts to provide healthcare services to the Department of National Defense is up for renewal. Calian has been D&D's provider for more than a decade, managing health services at D&D installations across the country. Last year, its current contract was extended by another 12 months, which increased its value by $75 million. Mr. Ford says he expects competition for the latest contract, and he speculated a new deal could be awarded in late summer or early fall. Mr. Ford also says Calian continues to look for acquisition targets that would either help the Ottawa company diversify its customer base or evolve its service lines. Calian says it expects revenues in its fiscal 2017 year to be in the range of $270 million to $290 million. In its last fiscal year, which ended September 30th, Calian reported revenues of $274.6 million.
Meanwhile, Dave, a leading Ottawa developer is teaming up with a local church on its latest project.
That's right, John. Windmill Development says it is partnering with Southminster United Church in Old Ottawa South on the new plan. Windmill partner Rodney Wiltz says it's too soon to get in any details of the latest project, but he did say that deferred maintenance costs are a significant concern for Southminster, which is located near the intersection of Bank Street and Colonel By Drive. Now, Windmill is no stranger to partnering with houses of worship on new developments. The company's Cathedral Hill project saw the firm build a residential tower at the Cathedral Hill church site downtown while maintaining much of the original facade. Mr. Wilt says it's not clear whether the addition of residential units would be part of the Southminster Church redevelopment, which has been the subject of discussions for almost 2 years. Windmill announced the project at a recent panel discussion that brought out church leaders from across Ottawa to learn more about how redevelopment can solve the problems of the modern church. Panel member Bishop John Chapman represents the Anglican Diocese of Ottawa and helps facilitate the Cathedral Hill redevelopment. He told the audience, Too many congregations cling to the churches of days gone by and refuse to accept or embrace their new role in society. He says many churches around the world are in need of serious repair or sit mostly empty. While this is a problem, he says it's also an opportunity to make use of the extra space and generate new revenue streams. The panelists said the best redevelopment for a church is one that aligns with the congregation's goals. This can often be achieved through partnerships, the panelists said. For example, bringing in social agencies or daycares to operate in the church's space and lean on churches' histories as community hubs.
That is very interesting. Thank you very much, Dave. And what's coming up on OBJ's radar this week?
Well, John, OBJ and the Ottawa Chamber of Commerce are building on their legacy of popular and provocative business get-togethers by launching a new event this week called Industry Insights and Issues, or iCube for short. The regular lunch meeting will feature speakers from a range of industries offering their thoughts on newsworthy topics of the day. The first iCubed event takes place this Tuesday at the Chateau Laurier and will focus on health innovation. The keynote speaker will be William Chernetsky, Ontario's Chief Health Innovation Strategist. For more information, go to ottawachamber.ca.
Thanks so much. Look forward to talking again next Sunday, 2 p.m., and have a good week.
You too, John. Thanks.
And now to Matt Hendricks. Well, it's great to be joined by Matt Hendricks, who is Senior Vice President, National Sales at Sprott Asset Management. How's your weekend going, Matt?
Pretty good, John, so far. How about yours? I'm sure you're doing some skiing, right?
I skied first thing this morning, great powder. It was wonderful. So I'm in a good mood, and we've got a big game later today. But let's get to the markets, Matt. We had good jobs numbers in the United States on Friday, but wage gains and productivity are lagging, and the Fed seems to be sitting on their hands regarding interest rates for the time being, and we'll have to see what they do in March. I'm expecting an interest rate increase then, and, of course, the market is encouraged by that, but also by the fact that the Trump administration is talking about lower taxes and less regulation. Now, what's going on in your world?
Yeah, John, I was just reading this morning about Trump deregulating, basically taking away all the safeguards that the Obama administration put in place after the financial crisis, Dodd-Frank. This could lend its hands to the U.S. Big banks like Goldman and J.P. Morgan doing exactly what they did before to put the world in harm's way. So, once again, having a very tightly guarded portfolio with defense has never been more important. So, John, again, I want to talk a little bit about income again today. And at Sprott, we are really adding value to our clients' portfolios. Scott Colborne and his diversified bond class fund, a global unconstrained mandate that still converts income into capital gains, is doing fantastic. And, of course, our alternative income fund with the private debt, including asset-based lending and factoring, is just blowing the doors off and adding a lot of value with very, very little volatility and, of course, zero correlation to the equities market. So our clients are very happy in that stance.
And you wanted to talk a bit about flow-through opportunities.
Right. So we talk about flow-through every time at this year, John. It basically what it is, it's like an RSP in that every dollar you put into this product, the flow-through limited partnership, you get to deduct off your income for 2017, and the investment goes into a resource-based investment into the Canadian resource space, whether it's energy or mining. Now, I believe that this is imperative for our listeners out there in CFRA Nation or in Ottawa that earn a high income, like a high T4, let's say of $300,000 or more, or even maybe more importantly, for those pensioners that are sort of in that $60,000 to $75,000 range that maybe make a little bit too much income and have their OAS clawed back. I mean, this is a way where you can reduce that income and make sure that you get your full allotment of old age security. So you should definitely talk to your advisor if you're in either one of those categories, because flow-through definitely could be for you. And again, it's been a great product. And why write a check to CRA and lose your money instead of trying to reduce your income? Give it to us and have us put it to work in the resource space and hopefully do a better job for you.
Well, how do listeners and advisors get in touch with you to find more about the strategies, not just flow-through, but all of the Sprott asset management strategies?
I'm always available toll-free at 866-299-9906. And, of course, Sprott.com. We have a great website with all this information on it. And I will say that the flow-through is time-sensitive. We really only have about 2 to 3 weeks left to take advantage of that. So again, if you anticipate having a significant T4, or if you're in that broad range where your OAS is getting clawed back, I highly suggest you call me directly or call your advisor, and let's talk about flow-through.
Well, Matt, thank you. And before we go, who are you rooting for in the game tonight?
I'm rooting for Tom Brady to become the most decorated quarterback in NFL history. So go Patriots, go.
Exactly. Thanks so much, and we'll talk again next Sunday at 2 p.m. on Money Talk. We'll go to a break. When we come back, Greg Bunnell talks about Hudson's Bay Company. Stay with us, folks. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
HBC and Macys couldn't be more different at the cash register. 7 of the last 8 quarters, Macys has reported declining same-store sales. Sales at stores open at least a year. While HBC suffered its first fiscal third-quarter decline in many years. But on a sales per square foot basis, it's a bit of a different story. Now, we don't exactly have an apples-to-apples comparison when they report their numbers. So this is the closest we can get to looking at the revenue and the total square footage. HBC sells about $18 worth of merchandise for every square foot. But Macys sells $25 in product per square foot. But maybe it's about the square footage of the land, not the shop floor, that matters to Canada's oldest company. For perspective on that, we take you live on location to the HBC flagship store in downtown Toronto and our real estate reporter, Greg Bunnell. Greg.
It's one of those situations you'll say, why would a retailer that's struggling in the face of e-commerce buy another struggling retailer? But as everyone says, when you talk about HBC and the acquisition strategy they've had over the past couple of years, it's not really been about selling things. It's been about the real estate that the stores are sitting on top of. They have 2 joint ventures, one with RioCan here in Canada, and then Simon Properties, the real estate investment trust behemoth out of the United States with a global presence. They have a relationship there as well. Indeed, Mark Satoff, a regular guest on BNN, telling us that if this Macys deal, and of course it's just a report as you were talking about the Wall Street Journal reporter, but if it were to come to pass, it would really be about making the value out of the real estate. Recall in 2015 when HBC went shopping in Europe, picked up Kaufhof Galleria, and that transaction, on the same day that they announced the purchase, they announced the fact that 40 of those properties were going into the joint venture with Simon Properties, and that's where they raised cash to put into the deal. Now, these joint ventures aren't available to the regular investor right now, but the way they've been structured with RioCan and Simon Properties has left it very wide open for an IPO of a real estate investment trust. That's been the big question hanging around HBC for all these years, because we know that Loblaw, Canadian Tire, they jumped in the game several years ago, and everyone said, well, HBC, we know you've got a lot of properties on prime locations, and then of course there's Saks Fifth Avenue. That's some pretty prime real estate in New York as well. The thoughts have been that they just want to build and strengthen the portfolio. The JV strategy is a part of that, and when they're ready, when they put the spit shine on the properties, well then we might see an IPO from this name in terms of a REIT. But we've been waiting a long time. Perhaps Macys part of that strategy as well. You're not buying a failing retailer, you're buying a lot of good real estate.
And of course, the health of a real estate investment trust depends on the health of the tenant on that land.
Everyone gets very excited about the idea of retailers, which have been struggling, realizing the value of these properties. And indeed, it's a very valuable proposition. $11 billion in real estate value, according to the latest HBC annual report. And of course, when you talk about Manhattan real estate, you could really be looking at a lot of value. So analysts will take a look at the stock and say it's trading below the value of the real estate per share. But as you said, be cautious. Once you launch an IPO and you have a real estate investment trust, well, you're really, in terms of those payouts, only doing as well as your tenant is doing. And if your tenant is a failing retailer, well, then you might have some challenges. But indeed, in the opening play of any of these real estate investment trusts that retailers are entering into, it unlocks a lot of value, billions of dollars of worth. So today you take a look at this potential deal, this potential buying Macys by HBC, and it really just boils down to the land that it's sitting on. It's worth a lot of money.
All right, Greg, thank you. Reporter Greg Bunnell, live on location at the HBC flagship store in downtown Toronto.
Now to Josh Ellman, partner at Greylock Partners, in conversation with BNN's John Ehrlichman.
So a couple things. The first is that the deep engagement of the users that they have. They talk about over 25% of their users, have 160 million daily users in December. Over 25% of them are posting daily their stories. Over 60% of them are capturing things on the camera. They're opening the app 18 times a day. That's just a really unprecedented addiction, about half an hour total time spent per daily user in the product. So that engagement, I think, is something really meaningful for their core user base.
Josh, as we try to look at those metrics and determine what kind of valuation a company like Snap Inc. should have, the idea of daily active users is not something that we've typically talked about when one of these high-profile social media-related companies has gone public. In the past, it was the focus on monthly active users. Maybe you can talk about the evolution in the terminology and why Snap Inc. would choose to really focus on a daily user versus monthly user.
I think for the first time, they're really talking about themselves as a media company. And I think they're really thinking about comparing themselves to things like television. When we talk about television, we look so much at the daily ratings. How much did each channel get? How much did each show get? And I think Snap wants to make the case that when you look at, 160 million people spending half an hour a day on their products, the amount of opportunities for advertising, especially this native video advertising that they're doing, feels a lot more like the overall media business rather than just being compared to kind of an internet property people check in on some occasional basis.
Giving the example of media, since the company is going to they're already using examples of their partnership with traditional media players. What do you think is the part of the storyline that's going to be talked about the most if they are spreading the word on themselves as more of a media player?
Well, I think it really is going to come down to what this advertising opportunity on mobile looks like. Look, we have seen users move to mobile at just such a rapid rate, as we talked about. Like, millennials probably spend more time staring at their phones than staring at a television screen anymore. And so, but the video advertising is still so large on, regular television. We're ready to see what that opportunity looks like when it really comes to mobile. And Snap wants to position itself with sound on, with this vertical video unique format to really be the player in this type of video advertising and see how much they can pull from regular media, not even worrying about the money that's also going to Facebook or Google.
Josh, there's no doubt that there are highly engaged users of Snapchat and that the growth has been really impressive. But when it comes to IPOs, people are looking at what's happening financially. And we can show our viewers this rapid revenue growth over the last couple of years and this rapid increase in costs. And that's why we're talking about a company that is not profitable. Now, you sit on boards. Obviously, you get financials from companies that are fast growing, and you've got to make a decision on what the business case is. What do you think people should keep in mind, especially those who maybe don't use the product and they see numbers like that and they say, I don't understand why this company can raise billions of dollars with a financial snapshot, if you will, like that?
Well, when you look at there's two parts to this question. The first is just the growth in the business. And when you look at a product like Snapchat, they've been focused so much on just increasing their reach. They haven't focused on optimizing their revenue yet. Facebook is now making about $19 per daily active user in North America. Snapchat's making $2 per daily active user in North America. So if they can even get that to $10 or $12 per daily active user, that their revenue, that's a big 5x at least in their North American revenue. So just the opportunity to kind of what I call filling in revenue on the existing engagement is very high. I think the big question then is, can they also increase their user base? Can they grow internationally? Can they grow in Europe? Can they continue to grow in demographics? They're very concentrated in sort of people 25, 18 to 25. They're very concentrated. It's not clear how much they are with people older than that. And so I think that's the big question is can they both fill in the revenue on the engagement they have, like Facebook has over the years, and can they find this new growth?
And Josh, just a final question. Since you've worked at fast-growing companies that have become leading technology companies, this is a company that has always been fairly private. They now have many employees, hundreds of employees, but the public spotlight does change the story. What do you think from how they manage their team, how they grow the business is going to be really important in determining how successful a public Snap Inc. can be?
It's a great question. I think the real challenge for them is keeping a focus on the sort of 5 and 10-year vision of the company they still want to become. This is something that Facebook has just done a marvelous job of, and Mark Zuckerberg's kind of holding the reins have been able to do that. I felt that LinkedIn did that as well with Reid Hoffman and Jeff Weiner. Twitter, I think, struggled to kind of paint that 5 to 10-year picture, and you've now seen that in the company's results. So it really comes down to the leadership. It comes down to Evan Spiegel kind of rallying the troops to say not, hey, we're now a business and that's what matters, but we still have 10 years to go to reach this mission, this idea of a camera company, the camera everybody pulls out to capture every moment they ever want to, is really the opportunity, and he has to maintain that.
All right. Great perspective. Always great to get your insight, Josh. Thanks for joining us. We appreciate it.
We'll go to the news, and when we come back, Ron Mayers, Family Office Executive at Blue Bridge Wealth Management. Stay with us, folks. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
We are seeing North American equity markets rally into the weekend. That's after losing a little bit of steam earlier in the week, that is for sure. For more on this and where he's seeing opportunity, we're joined by our featured guest, Blue Bridge Wealth Management's Ron Mayers. Ron, let's pick up the story on the markets. We talked a little bit about Dodd-Frank, of course, but I just want to first get your take in terms of the potential that Hudson's Bay might be buying Macys. What's your reaction?
Well, it's an interesting proposition. As you know, both Macys and I guess at about the same time, Sears just announced just dreadful quarters and really showed the impact of online shopping versus in-store bricks and mortar type shopping. And Macys is therefore vulnerable, and in a move that is somewhat resonant of Robert Campo's buying of U.S. Retail assets in the late 70s and early 80s, Hudson's Bay is now looking at another U.S. target and trying to extend, their expertise, and they've actually done fairly well in their context to Macys, which could certainly use the help.
But what's the strategic rationale for doing this? A lot of people would say it's to unleash the value of the real estate portfolio, split it off maybe, but at the same time too, we've seen that story with other retailers in the past. Sears, for one. I mean, over a decade ago, you had to have the retail analysts and the REIT analysts start to work together to write these reports, and that didn't work out. I mean, mind you, Hudson's Bay is a very different story versus Sears. But why is this a good idea?
Well, I think you hit the nail on the head. The underlying real estate is always an opportunity for the acquirer to generate some value. The problem with that theory, of course, is ultimately you milk the real estate for all it's worth, and then you're still left with a bricks and mortar retailer. In that context, Hudson's Bay seems to have a better formula than some of the others. More, I guess, more along the lines of Nordstrom, although I'm not a retail analyst. Macys seems very, very tired, as does Sears, and to the extent that they can A, eliminate a competitor and consolidate, and B, bring their own marketing platform, they've got a shot. Okay,
so perhaps controlling the industry a little bit more by making this acquisition, if they do it. Ron, let me get your take in terms of how you're looking at the market, and of course we've had such a Trump rally since November the 9th. What's your take right now and how you're positioning your clients?
Well, Blue Bridge's attitude overall, and it has been for the past few months, is that equity valuations are getting quite stretched. The future earnings are trading at or near all-time highs, and while every market is different, at some point something has to give. The thought was the third quarter earnings going up might add, right, because that's the denominator to the price earnings ratio, might add a little bit of strength. And so far, they've been okay, but they haven't been gangbusters. To the extent that some of Trump's economic policies or Republican economic policies can be put into place early on, you may, for example, tax cuts, you may see that go right to the bottom line, and that would be certainly helpful. But it's hard to see that happening in time. So we are starting to move away from North American equity markets. We are much more focused globally now. We're looking beyond the public markets to private equity. We think that there are opportunities in real estate, not merely in North America, but globally in particular. We've started investing in some credit funds as an alternative to traditional fixed income, because returns are getting harder and harder to find. I mean, bonds are very, very, they're very expensive still. We think that inflation is going to be a big theme.
Inflation is going to be a big theme, meaning you think that we will actually see higher inflation? Well,
if the Trump administration is true to its words, the policies they're discussing can be very, very inflationary. You're talking about things that will tighten the employment market, rising interest rates, really threaten to bring on inflation, I think, faster than some people anticipate.
Ron, when you take a look at private equity right now, as well as real estate, if in fact we've got a rising interest rate environment, presumably that would decrease the present value of investments that you've already made, correct? So
that's true.
So why are you a little bit more concerned about stepping into private equity or real estate right now?
Well, in private equity, interestingly enough, what we're looking at is secondary funds. These are funds, I don't know if you're familiar with the concept, but these are funds that come in and buy existing private equity positions from investors who want liquidity. And as a consequence, they have a more, if you will, more mature, more developed portfolio. So you actually have a sense, you have an opportunity to see where that where the investment is along the time scale. It eliminates that J curve where your money almost does very little at the beginning and then you get very high returns at the end. And it avoids the problem that so many people are having with private equity now in finding appropriate opportunities. Number one. On the real estate side, by moving away from North America and looking elsewhere, for example, one fund that we've got under consideration right now, we haven't taken any firm action, has a global real estate portfolio with real estate teams located on all of the continents in which it invests, bringing local expertise to bear. And we think that's where you're going to be able to find opportunities.
Okay, Ron, we have to leave it there. Great to speak with you as always. Thanks so much.
Good to see you.
Thank you. That was Blue Bridge Wealth Management's Ronald Mayers.
We'll go to a break, and when we come back, John Ehrlichman talks with Jameson Burkow about the Toronto real estate market. Stay with us, folks. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Well, we continue to monitor those soaring home prices in the Greater Toronto area. It's our top line story this morning, and Jameson Burkow has more.
Well, the mayor of the city, John Tory, made an interesting point off the top of the hour in that clip that we just showed, John, about supply being a really important factor in this. Just barely half the number of homes that were for sale in 2016 were for sale in 2017, looking specifically, of course, at the month of January. But you know what another factor is that is definitely at play, even though you couldn't necessarily put a specific figure on it? That fear of missing out. Good old FOMO, John, because I did promise I was going to come back with a little bit more of the quiz show format, so we are going to play Name That Quote. I'm going to put a quote up on the screen. I'll read it for our viewers, and then you can tell me who you think said it.
Okay.
This is in response, of course, to the Toronto home sales figures from January. Folks, you need to drive and downsize to qualify, and you better hurry before even these last affordable options become out of reach.
Your realtor?
It does sound like a realtor might have said that, right? You know who actually said it? The reason I put it up there is because it's difficult to actually pin this on the person who actually said it. But it was Doug Porter, the chief economist of the Bank of Montreal. You're talking about fomenting FOMO. Coming from one of the most prominent economists in the country is an interesting source of it, but I want to, of course, to provide the other perspective on this. It's important to look at, say, what the Bank of Canada thinks about this. Their last financial system review from June of 2016. Here's the most important point where they point to those rapid paces of increases, raising the possibility that prices may be supported by self-reinforcing expectations, folks. I added that folks there for you. Making them more sensitive to an adverse shock to housing demand. So that very clearly translates to the growth could be coming largely based on expectations for similar growth, which, as every single expert anywhere will say, is not something you should count on.
That big boot in your imagery there, I think, is that of Patty Levitt-Reid, who comes on every day and reminds us that we are taking on more debt, and you shouldn't necessarily get...
That's far too unfashionable a boot to come from Patty Levitt-Reid, I'm sorry.
That's true. Okay, let's dig into the numbers a little bit more, because you did talk about overall sales being greater, but there's a sort of a caveat here.
It's true. It's really interesting when you see where that growth in sales is coming from, John, because it's definitely not across the board by any measure. In fact, it's kind of weird. It's coming almost entirely in terms of that big growth from condos, both in the 416 in the core of the city and in the surrounding suburban 905 area code. 27% more condos in both of those markets selling this January than in the January of last year. The only other market segment that posted a double-digit increase in sales was suburban homes in the 905 region. You compare that to, John, what happened in the core of the city, in the 416. Both detached homes and semi-detached homes. If you ever tour real estate across the core of the city in the 416, you know that the semis do make up the vast majority of the inventory if you're looking to avoid the condo market, of course, in the 416. Both of those segments actually down year over year in terms of sales. We're selling less detached homes and less semi-detached homes in the 416, so the only growth in the core of the city coming from the condo market and the townhome market to some extent. And then, of course, the 905 semis also posting a decline, which is just an interesting, probably, I'll get some more analysis on it, but could just be serendipitous, but is an interesting trend to see this start to happen. It's similar to what we saw actually in Vancouver even before that foreign buyers tax was put in place last August, which of course did accelerate the trend of sales declines, which are now translating into price declines. So it does speak to the affordability issue and, of course, that whole point that Porter was making. I mean, drive until you can afford.
I have not looked at the most recent on-the-record quote from John Tory on that issue, but I never got the sense that he wanted to follow Vancouver's lead in implementing a foreign ownership tax.
Quite the opposite. Yeah. In fact, whenever he's been asked about it, he goes on a very long soliloquy about his desire to ensure that Toronto remains an attractive place to invest for all investors from everywhere. So if he were to do an about-face and, support all of a sudden some foreign buyer tax, not to say that no politician anywhere has ever done a 180 on their policy positions before, but it would, in fact, make that call. It would be a full 180 from his previous position. The province, though, interestingly enough, because remember, it wasn't the city of Vancouver that put this in place. It was the province of British Columbia. So Ontario's government, they've actually been kind of, we're looking at it. So they've left the door open to doing it if they decide that makes sense, but I imagine they're going to want to keep watching the BC market.
Just another reminder that this story is complicated because of all the different regulatory bodies and politicians who are weighing in, and ultimately the differences you see in markets across the country, for sure.
Yeah, the real challenge, of course, is going to be figuring out some way, because obviously the federal government, John, is trying to, and we talked about this last hour, find a way to essentially prevent months like the one Toronto had last month from happening.
Yeah.
It's not working, at least not yet. So if we do see more intervention from governments, whether it's municipal, provincial, or federal, that's kind of the wild card through all this, because we know all the other factors like some sort of economic decline, an adverse shock to demand, all those other things, that's something we can kind of account for, whereas the government side, that's the stuff that tends to come out of left field.
Jameson Burko, thank you very much.
Now to Catherine Murray of our affiliate BNN in conversation with Lindsay Wasser, who is partner and co-chair of Macmillan Cybersecurity Group.
It has taken over the computer systems of hospitals, police forces, governments, and businesses of all kinds. It's called ransomware, and the cybersecurity attacks are expected to get worse in Canada. So what should you do to avoid being hacked? For more on this, we're joined by Lindsay Wasser, partner and co-chair of the cybersecurity group at Macmillan. Lindsay, good to be with you. Thanks for coming in.
Oh, my pleasure.
I don't know how many people have heard of ransomware. I had not.
Okay.
That doesn't necessarily mean anything, but what is it? Talk to us a little bit about this first.
So basically, ransomware is a type of malware or a computer virus that encrypts your files or your data or your system so that you yourself as the business can't access your own data or systems. And then what happens is once they've managed to infect your device or your system, you'll get a pop-up note saying, we've encrypted you. If you want to access your data again, you will pay us X amount. It's usually in Bitcoin, which is a digital currency that's difficult to track. And they say often if you don't pay us within a certain time frame, and often it's pretty tight, 48 hours, for example, we'll destroy your data or you'll never have access to it again. So it's a very much a panic-inducing situation for a lot of organizations when they get this message and they cannot get access to their own files or systems.
And Lindsay, you brought this topic up to us for the Business of Law segment today because you are getting more and more calls that this is happening, or at least people are more aware of it and they don't want it to happen to themselves. So what are those conversations like?
Yeah, absolutely. I certainly, 2016 was probably the most calls I've had from clients who've had a ransomware incident. And I think that is not unusual. I've heard 2016 referred to as the year of ransomware. And there are some sources that predict that ransomware quadrupled in 2016 and will double again in 2017. So it's becoming more common. In addition, the nature of the targets has been changing. So when ransomware first started coming out, and it's not new, but they often attacked individuals. So you'd be at home working on your computer, all of a sudden you'd get a pop-up message, you'd find you can't access your family photos. And so ransomware would affect you there, and usually the level of ransom would reflect the fact that they're attacking individuals, so a few $100s. Now they're attacking more businesses, and the level of the ransom is rising to the extent that businesses can pay thousands of dollars instead of hundreds of dollars. So often going after small or medium-sized businesses that may have less robust cybersecurity programs, or what they call soft targets, like in educational institutions or healthcare institutions that may not consider themselves to be the primary target of cyber criminals, because it could be, in some instances, that the data that's being attacked doesn't have a market value. It's difficult to resell. The thing is, with ransomware, the criminals don't have to find a buyer for your data. As long as you need access to the data, they have a way to get money from you.
Lindsay, why are these people calling you?
Well, they call me to find out. I mean, often the question I get is, what should we do, right? So the question that I always ask first is, do you have backups? And how current are your backups? Because if you can restore your own data, then the incentive to even consider paying ransom goes down, and there are a lot of good reasons not to pay the ransom. But if you cannot restore your own data, and they have managed to encrypt critical key business information, then you have to decide. You have to make the business decision. Are you prepared to pay the ransom? And, you know, there's no guarantee that if you pay it, you're going to get your data back. You could be attacked again. They could ask for more money. If you do pay, that money might be going to fund criminal organizations. So there's a lot of factors that come into play. Now, from a legal perspective, you also have to think about, well, what are your legal obligations? And big factor there is, do you have a breach notification obligation? Do you have to report to the privacy commissioners or to individuals if personal information is involved? Well, it sort of depends on what the criminal has done. If they've only encrypted your data and there hasn't actually been any viewing of the data or any exfiltration of the data, maybe you don't have to report. On the other hand, sometimes ransomware is a cover for what they're really doing, which is stealing your data. And then there may be a breach reporting obligation. So your lawyers have to work with your technical team to understand what exactly has happened from a technical perspective and then assess what your legal obligations will be from there.
Which would be, I think, very difficult just by the nature that these are hackers to begin with.
It's true. Yeah, you'd certainly want to have good data security experts. I mean, you may have an in-house team depending on the size of your organization. They may not be sophisticated enough to handle this, but there are certainly external technology firms and data security firms that can help you deal with this type of an attack.
All right, Lindsay, we have to leave it there. Really interesting. Thank you very much.
My pleasure.
Thank you.
We've never seen anything like this before. This is a new kind of U.S. president, one who seems to rule by executive orders and also connects with his constituency via Twitter and scares the daylights out of CEOs who have to do long-term planning to make sure that their businesses survive in what is left of a global marketplace. Markets are heartened by the prospect of lower taxes and less regulation, but it feels like we're on the edge of a new and unprecedented era of protectionism, Trump style. I'm not smart enough to figure out where this is all going to go, but I know that there is a lot of risk and would suggest that investors talk to their advisors and really take stock of their situation and consider a defensive strategy. Thank you for joining us today on Money Talk. We'll be back next Sunday at 2 p.m. Have a good week. I'm John Budden, and you are listening to 580 CFRA.